What is up, everybody? In this video, we're going to talk about volume versus volatility. What is the difference and how to identify volatility in the markets. But before we get into that, I do want to talk about the green legacy visor that I've been wearing in pretty much every episode since I debuted my face. It can't exist anymore because we now have a giant green screen behind us. And since the visor is green, you can now see through my forehead, and well, the visor's not even green. It turns out to be like blue or some shit. So I just kindly ask all of you to have a moment of silence with me as we officially retire my green legacy visor, and I just want to kind of reflect on some memories I've had with it. All right, guys. Well, seeing how this is the last time you're gonna see it, let's take care of that and get rid of her. So, obviously, I need to wear something different at this point. I need a different piece of headgear, and I think I figured out exactly what it is. A yellow visor. So it's not quite green, but it's kind of the same thing. It's me. It's just a different color, and it works. So there we go. We got Mike Belfiori's back. I got my visor. I kind of like the yellow. The yellow's nice. I will miss the green, as it is, again, the official OG visor. But let's go ahead and get into this episode. So let's talk about volume and volatility. And I think the best way we can do this is to pull up this charts, or just my trade session from the last FOMC session. Okay, now that we have this pulled up, let's just talk about volume for just a moment. So over here is the time and sales in this section right here. So the thing about the time and sales is I do have a video on time and sales. You should go watch that. So your time and sales is essentially going to be the volume coming into the market. So if nothing is coming off the time and sales, then there is no volume coming into the market. Whatever's printing on this time and sales is exactly the same orders that are printing right here in the center column of the depth of market. Okay. So the only thing is with the time and sales is it's showing you orders executed by an individual trader. So as we can see right here, somebody sold 10 lots. Now that is one transaction of exactly 10 lots from one seller. Now down here we have 3 lots, and that is one transaction of exactly 3 lots from one seller. The difference being is you see 145 right here. Those are the same orders coming in from the time and sales, but the difference being is on that center column is all the orders are just being added up right there. So you're not able to see the individual orders per individual trader as they come through here. Now there's more advanced things such as large traders can cut up their size. So one trader could cut up his order to stay more hidden and to prevent the market from moving by submitting that 10 lot and that 3 lot and that 1 lot and that 4 lot. That could be one trader, but either way, he cut the trade up. Sometimes the time and sales has the orders cut up, and what's happening is it was submitted as one larger order. It could have been maybe a 20 lot, but the market is sweeping. That's more of an advanced thing. We're not going to talk about sweeping. We're going to keep it simple, but if you would like to know about sweeping, I do have a video on sweeping, so go check that out because I do talk about it in a lot more depth. So now that we understand that we have market orders coming in right here, if none of these market orders are coming in, the market will never move. Okay. And the red and blue column, those are resting orders. Those are your limit orders. Okay. What you'll often see is these numbers go up and down. Okay. They'll go up and down, but just because you see those numbers moving doesn't mean anything. Because until market orders execute limit orders, then the price will never go up or down, and then there's no trade. So volume, the difference between volume and volatility is, we'll start off with volume. Volume is the actual market orders coming into the market. Volume is simply a measurement of market orders and and that's it. So sometimes we have high volume, so that could be a lot of orders coming in. And if a lot of orders are coming in, you're going to see the time and sales go really quick. If there's lower volume, the time and sales will go a little bit slower. We're going to play some examples between high volume periods and low volume periods, and I will point out on the time and sales the difference, and you'll visually see it. Now, you could also see how fast they're coming in on the center column. I do think it's easier to have a time and sales up to see it, because you can just see it going downward and it can be moving real fast. Whereas if you're trying to watch how fast the volume is coming in on these center columns, since the price is moving up, you have to kind of keep track of where it's going, and it's going to be harder to know if it's coming in faster or slower because of how all the numbers are overlaying. It's just kind of a mess. It's just easier to see it on a time and sales because it feeds downward. Whereas on these center columns, the price is constantly going up and down, and some of these orders in the middle can be older, and then it's harder to track. So the market will never move unless we have volume. Now, here's where it gets interesting. Let me pull up an old school video. So this is my very popular how to read a DOM video from fucking forever ago. And I don't know, here's the ES. You can obviously see the ES is a lot thicker back then than it is now. I mean, 400, 300 lots. Now, here's what's interesting. All these markets have different average sizes, okay? We'll look at this one here and this one here, okay? So as you can see, there's like 6,000, 2,500 lots, roughly about 6,000 on average per bid and offer in this market right here, whereas the ES back in this day only had 400 to 500. So in order to clear out a limit order in ES back then, you would need to see the volume. You would need to see 388 orders hit this bid to just move it down one tick. Whereas now, you only need 53 lots to move the ES down in this current environment. So if somebody submitted an order for 388 lots, I think that's how many was sitting on the bid in that last example. So if somebody submitted one order of 388, we can't really see because there's an arrow right here. But if they submitted 300 orders, it would sweep this 91, 95, 123, and it would probably drop the market 4, 5, even 6 ticks. Okay? Whereas in that last example, which I'll pull up, if somebody submits 388 lots, it'll only drop 1 tick, assuming that order isn't fake and it pulls. Okay? So while we can have a specific type of volume, let's say we have an average of 100 orders come in per 10 seconds, okay? On average, 100 orders per 10 seconds. My cats are fighting behind me, by the way. So you might hear them trying to kill each other, so they're play fighting. Oof. Hey! Quit fucking with each other. All right, that was getting a little annoying. So, anyways, let's say we have 100 orders on average coming in per 10 seconds, okay? Well, off the time and sales. So, again, let's pull up that time and sales. So, here's our time and sales. On average, the orders can be cut up, but about on average, 100 orders per 10 seconds, right? So, in this current ES environment, you'll have some volatility. It may start clearing out the bids and offers. So what's happening is the market is going to start bouncing. Whereas in the old ES environment, 100 orders per 10 seconds, the market's not going to be as volatile. It's not going to be as moving as much because the order book is a lot thicker. Now, if we look at this market here where you got 6,000 lots on each bid offer, hell, man, the fucking market may not even move at all when you get 100 orders per 10 seconds. 100 orders every 10 seconds, I'm sorry. Now, let's take a look at the NQ. Let's see if I even have an example of it, so give me just a moment. Okay, so here is the NQ, which is a drastically smaller limit orders on average per bid and offer. So if you have 100 lots come in every, 10 seconds, well, that's going to definitely move this market a lot. So therefore, the same amount of volume in different markets, depending on how thick the DOM is or the order book, is going to drastically affect the volatility of the market, okay? So thinner books like this, it takes less volume to move it. Thicker books, it's going to take a lot more volume to move it the same amount. So as you can see, having the same type of volume in different markets will have drastically different results. Because not all markets are the same. Some are thinner, some are thicker. Sometimes they change for good. As you could see, the ES pre-COVID was a lot fucking thicker. Now it is a lot thinner. I have theories on that, but I'm not going to get into that in this video. But it takes less volume to move the ES. Now, the thing is, and what I think is going on now is... the ES is a lot more choppier than it's really ever been, in my opinion. So what I believe is happening is the same overall volume is coming into the ES as it has in the past. But the thing is, now you're having larger traders cut their orders up more because it doesn't take much to move it. So they got to hide their orders more, iceberg stuff, cut it up on the time and sales so they're not sweeping areas. Again, I really do think you guys should watch that sweeping video I mentioned earlier in the video. So that is volume, and that's what I believe is going on and why the ES is choppier. Because if you look at a daily chart, the volume histogram, the traditional volume histogram, it's roughly where it's been, if not a little bit higher at times from post or pre-COVID days. Whereas the order book is a lot thinner. So therefore, the same amount of orders are kind of coming in, the same amount of volume is coming in the session as it did back then, but the liquidity simply does not exist. And again, liquidity is simply another name for the resting limit orders on the order book. So as you can see in the NQ, there's not much liquidity. It's extremely thin. So now that we kind of know what volume is and it's just market orders coming in, let's talk about volatility a bit. We kind of touched on it a little bit in this video, but let's dive into that because this is a very important thing. Okay, so volatility is essentially going to be how much the market is moving up and down. Is it going up and down really quickly? Or is it kind of not, and it's just getting stuck and barely moving? That is volatility. Now, sometimes the order book, the liquidity can thin out on the ES, and I will show you examples of that. And when that happens, it takes less volume to create more volatility. Whereas if the book is thicker, it's just... that same type of volume won't create as much volatility. So this is why they have a relationship. Let's talk about volume for a minute. If the book stays the same amount of thickness, you're going to need more volume. You're going to need more pacing on the tape to move the market, to get more volatility out of it. You're going to really want this tape to really be going quite quickly to create more volatility. If this tape slows down, well, there's less volatility, and the volatility is constantly shifting throughout sessions, okay? This happens to be FOMC, so this is going to be the best example of all sorts of volatility. So now when the book thins out, obviously a high amount of volume is going to really make it manic and super volatile, Whereas once that tape starts to slow down, the volatility will also decrease. So I believe examples will be a little easier to follow. So let's just press play here. Now, as you can see, the volume, you can kind of see all the orders coming in. Only a one lot came in, it paused, and then a bunch of sell orders came in. And now the volume is starting to pick up. The volatility is still roughly the same. And one of the easiest ways for me to identify what is average volatility is by simply looking at a 3-second chart. So this black area right here is a 3-second chart, whereas this is Sierra charts on a different screen. That's a 30-second chart. This is going to be Jigsaw's Auction Vista, and this is kind of how I gauge whether the volatility is good or not. By the way, if you guys would like to save $30 on Jigsaw trading, link in the description, and use my coupon code. You'll save yourself $30 on Jigsaw if you've been considering it. But anyways, let's continue to talk about this. So as you can see, this is a 3-second chart. Notice that the average pivot and rotation is about 4 ticks here. The average pivot and rotation from here to here is about 4 ticks. From where I put this to here is about 3 ticks. From up here to here's 3 ticks. So we're getting about 4 to 3 tick rotations. Okay. So for me, that is bad volatility. There's not enough volatility. It's not moving enough. It doesn't matter how fast these market orders come in. Yes, it does matter, but there could be reloading or something. I want to see those bars moving a lot more. I want to see an average rotation of maybe 6 to 12 ticks. So let's kind of just play it and just look at it for just a moment before we transition into high volatility. And if you want, you can kind of go back and forth through this section and the next one just to see the time and sales, to see the volume, to see how thin the book gets and how thick it is now. So notice that, yeah, I mean, the tape isn't feeding super fast. I can kind of read every one lot coming in. The market is stuck here. Absolutely no volatility, period. Then you got a nice little cluster of orders. So notice how this tape suddenly went quicker. Notice how we had a more volatile move because of that. Let's go ahead and look at that again. So again, it's real slow on the tape. Then it picks up speed, and we get more of a volatile move. Okay. Now the tape is slowing down a little bit. Yes, you do. It kind of is pacing okay, but the average tempo is, yes, it's picking up. There's a bit of more volatility right there. Take a trade, which I believe ends up becoming a loser if I'm not mistaken. But we're not going to look at this trade per se. So yeah, see, and I'm getting trapped in the trade, and there's a lot of problems with that. There it goes, and now it's working out. But and it's still not good volatility. I don't remember what this trade becomes. I believe it does become a loser if I'm not mistaken. But I end up waiting for FOMC in this particular session. I'm like, this isn't even worth a shot. And you'll see. So again, we're getting this average of 4 tick rotations, which really sucks. So yeah, we did have a brief moment of volatility here, but the average rotation is 4 ticks. So that's how I'm gauging shit. So let's kind of go ahead and look at when the order book thins out. So let's go ahead and look at it. Now, this is going to be 5 minutes before FOMC. So I just want to kind of point out something here. As you can see, the average rotation is starting to increase. Now it's what? 1, 2, 3, 4, 5, 6, 7 ticks per rotation on a 3-second chart. Over here, it's a lot taller, right? We got 1, 2, 3, 4, 5, 6, 7, 8 ticks. This one might be about 12, but either way, we're kind of in that, we're no longer in that 4 to 3 tick range. So the volatility is a lot more, but if you also look at the order book, it's starting to get progressively thinner. So it's going to take less orders feeding on the tape to move it more. So the time and sales here, let's go ahead and just play it up until FOMC. See, it's feeding in about the same, maybe a little higher pacing than it was in the prior example. Okay, maybe about the same amount of orders are coming in, but you're getting more volatile movements because the book is progressively thinning out. Okay, and this is going to be we fast forward a little bit. This is going to be 2 minutes before the FOMC release. Now, notice how there's only 5-10 lots here. The book is getting progressively thinner. You're getting more volatile movements here on about, well, roughly same amount of market orders are coming in. So since the book is thinner, the moves are going to be a little bit bigger. So we're going to go ahead and wait until the release. And again, watching the time and sales. It's not moving really any faster, maybe a little bit faster than in the prior first examples. But as you can see here, the volatile movement, like the average movement on this auction vista is bigger. It's taller. It's not these 4-tick ranges. And that's because so what's going to happen here is right as the FOMC releases, we get, not only do we have a super thin book, but we get flooded with market orders right here. And when we get flooded with market orders on top of a thin book, it creates insane amounts of volatility. And you are about to see that here in just a moment. So let's just keep watching. Now, there are points where people are putting in larger bids and offers. Right now, watch how fast this tape starts to feed in here. So we got a couple seconds, still bigger amounts of volatility. Clearly, it is more volatile. Again, how far is the average rotation on the 3-second chart? And by looking at these bars, it just helps me understand, is it good volatility or is it not? There is a specific type of volatility I'm looking for. I have 2 videos I always recommend, Sweet Spot 1 and 2. And looking at that average amount of volatility is really key for me to dial in not only my approach, certain techniques I want to use, and if it's too low, it's not in my sweet spot. If it's too high, it's not my sweet spot. So with that one trade you saw me take, the volatility was too low, so therefore we weren't in my sweet spot. Right before this release, or right when this FOMC release happens, the volatility be too high. So we're going from one extreme of my sweet spot to the next extreme. Now, what you're going to notice me do is when I actually start to execute, I'm waiting for the market to slow down to come back into my sweet spot. So watch this time and sales. Watch how fast it's feeding. We're not getting mid-size orders really hitting here, because if they did, they would sweep the market. So now a lot of the larger traders are cutting up their orders. And it should be blasting off here in just a moment. Market is getting a bit spready there. There it goes. Notice how many, look at all these mid buys that just came in. See how all these mid buys, everything went blue? The order book is so thin that it just drove it. Well, it drove it way off this chart. We were here and now we're to fuck up here. Whereas if the book was thicker, this same type of orders coming in, and these are only like 10s, 11 lots, all that. That same type of volume would not move it as much. But now you got like 5 lots, 2 lots, 4 lots. Look how spready the market is. The bid is here. The offer is way up here. So there's nothing in between. So if there's nothing in between, well, then the market is going to, if a bunch of sellers sweep this 9 lot here, well, the market is going to collapse from way to fuck up here all the way down there instantaneously just on 9 lots. So look how fast these 1 lots are feeding in, right? More mid-size orders are coming in right here. So, but the book is still super thin. You don't want to trade this environment because if you have a stop, what's going to happen is, let's assume we have a stop loss right here at 52.75. The problem with the stop is it's a market order. And once the price hits right there, a market order is triggered. But the problem is wherever you're trading from isn't right at the exchange. So if I have a 4-lot market order, if somebody sweeps this 4-lot before my stop order can eat it up, then I'm going to experience something called slippage. And oftentimes when the market is super volatile like this, a bunch of orders like this 4-lot can get taken out, this 10, 10, 9, 5, 3. Hell, even these orders might start pulling down the 2 lots or something. But all these can get swept out or cleared before my market order goes into the exchange and executes. And I will experience something called slippage. So a 6-tick stop loss can end up becoming a 15-tick stop loss. So it is very imperative that you just don't even trade this type of volatility. While it seems enticing because it's moving, this isn't good. Because if you're wrong, you're going to experience really bad slippage. So as you can see, the order book is super thin, lots of volume too. So not only do we have a thin order, but we're having a lot more volume than we even saw when the session was a lot slower. You got a lot of mid-sized tape feeding in over here and a combination of a lot of retail orders coming in as well. So if the tape was feeding about this quick in a thicker environment, you would not have these insane jumps in price. But since the environment is thinner, you're getting more jumping. And as you can see, she's going through the roof. Again, we shouldn't trade this because this is how you really fuck yourself. Ask me how I fucking know, because I've fucked myself in this multiple times. So she's all over the place. Now, let me go ahead and we're going to fast forward to when I start actually executing. Okay, so now that we've fast forwarded about 10 minutes after the FOMC release, now we can see that these average bars aren't so fucking extreme. Just go back in the video a little bit. I'm not going to do it, but these bars were so tall. Fuck it, I'll do it. Okay, so look how tall these bars are. Look how extreme these bars are, right? Look how extreme the bars are. Let me go back here. Right? Look how tall, look how extreme they are. Just like that. Now let me go back forward. Now things are starting to get stuck a little bit. Now we're not seeing such extreme movement on these bars. Again, it's a 3-second chart. So we're actually seeing the price get stuck in certain areas. So now what's happening is the order book is a little thicker. Notice how it's 30 lots instead of like 4 or some bullshit. So now the market is getting thicker. So that same type of volume where we saw coming in, while it could still be pacing the same amount on the time and sales, it's not going to make it as volatile because, again, the order book is thicker. So what we're going to do is we're going to watch some trades get executed, 2 trades. Okay. She's still pretty fucking volatile. It seems like the tape is about the same, I would say, but the volatility is nowhere near as insane as it was before. Still relatively volatile, still moving, still pretty violent, because the way this tape is just feeding in is it's a high amount of volume. So we still have high amounts of volume, and we still have a relatively thin book as well. So there's an actual setup I'm attempting to execute, and I'm not going to go into that in too much detail, but as you can see, there's a bell curve up here, and we're essentially bottom ticking this bell curve, and what I'm doing is looking for a long, but there's more to it than that. There's other things happening that key me off to actually wanting to execute it. So what you're going to see is I'm going to get in, and then I'm going to take a loss of, I believe, $600, and then we pick up a nice big fat win that more than pays for this loss. So what happens is I'm gonna end up, it's not working. So what I try to do is I execute with the flat key because it's so volatile. that trying to work a limit to get out of it is pretty difficult. So for me, it's a little easier just to work a flat key, because the DOM is moving too much to like physically execute a limit order is going to be a little difficult. So I do hit the flat key, and I believe it's a full stop on it as well. Yeah, we take a full stop right there. That's okay, though. It's no big deal, because there was a solid setup there, and for me, that was a good loss. She's getting a little stickier, a little thicker. Nice puke right there. A lot of mids hitting here. So this is a really good volume. Now, if we saw this type of volume in the very first example, the market was rotating, 4 to 3 ticks on average. If we saw this type of volume in there, we would get about 8 tick rotations. But since, again, the order book is thinner, we're going to get even bigger rotations. So this is also really good volume as well. So we get filled, and it obviously sweeps through us. Now, I do believe that first and foremost, as a scalper or a day trader, volatility really is your friend. You do need volatility. Obviously, you don't need that initial FOMC volatility because it's too much. But it's a lot easier, in my opinion, to get into trades because it's more forgiving. It's easier to get break evens. Whereas in those lower volume, lower volatility environments, you tend to get trapped in trades. It's a lot harder to get out of trades because sometimes there's not enough market orders coming in to execute a break even for you if you're trying to work a break even or a small loss or whatever. Sometimes there's just not enough to maybe even execute a one-tick win. Whereas when you do have some sort of volatility, it'll often test your price multiple times, and it gives you a lot more opportunity to actually execute the trade for a break even or a little win or whatever. And also with good volatility like this, you're going to it's just going to be easier to gauge if the trade is going to work out in your favor. Whereas in really low volume, really low volatility environments, it can get stuck and just over chop your location. And if you intend on scalping, you do need volatility, A, because you get more ticks, so it pays more money. And B, as a scalper, you typically want your trades to start to work out immediately. You don't want to sit there for 5 fucking minutes to figure out if it's going to work or not. Because in those low volume, low volatility environments, there can be a brief moment where the volume and volatility pick up and stop you out, and the market goes 8 ticks instantly. But on average, in a low volume, low volatility market, there's not enough volume and volatility to hit 8 tick moves to recoup that 8 tick loss or whatever happened. Okay. Whereas in these higher environments like this, it's actually moving. So it's going to be easier to recoup a stop because it's actually moving. So it is a lot easier. Within reason, right? Trading isn't easy. And also, if the volume and volatility are too extreme, that's a problem. And you do have to be pretty careful in certain areas on the structure of the volume profile, and sometimes the volume and volatility contracts. And that can cause problems. See, as you can see, it's going against me 3 ticks, but it's not a big fucking deal. Because the volume and volatility are in this market, whereas if we were trading a lower volatility volume market where the average bar rotation was 4 ticks, it going against me 3 ticks could be a real problem because it may not even come back. So it's more forgiving, and we can figure out if it's going to work, and there's more areas where it can hit pockets where it pops further. So this is an actual setup again, trying to mean revert the trade. As well. So we'll just continue to watch it. So now the volatility is contracting ever so slightly. You're getting 1, 2, 3, 4, 5, 6, 7, 8 tick rotations, which for me is sort of sweet spot area. So the average pivot and rotation, because the ES is always chopping on a 3-second chart, no matter what. these 8-tick rotations. We take a 1 lot off right there. Then she hits a pocket where she blows out, right? 1, 2, 3, 4, 5, 6, 7, 8, 9 ticks, right? It's still going down, but it pulled up briefly, and then she's shooting down a little bit. That's fine, but you're still getting this sort of, now it's getting more volatile, more of a volatile movement right here. We take off some up here, and I believe I get completely flat up there. And that was actually a really good trade, and it completely erased the last loss and everything else before that. And we make really good money really quickly on that trade. Let me take a look and see how much that was. Yeah, so that was a good trade. So we made 1,350 on that specific trade. So we more than doubled that stop loss right there. So that was really no big deal at all, completely erasing that loss. And again, had I hit that stop out in a low volume, low volatility environment, there's no way I'm going to have this type of move set up that quickly, that soon. So that's what volume and volatility is. That's the difference between the two. That's how volume and volatility commingle and how they interact with each other. And the best way to really gauge if the volatility is good or not in the ES, now this is going to be different for other markets with thicker books like bonds or thinner books like NQ. But the best way to gauge it is by having a 3-second chart such as this. And what I like about the auction Vista with Jigsaw is it has these little black lines in between each bar, so you know precisely how many ticks each bar went. Whereas if you're looking on Sierra charts, you don't see that, so you can't kind of count out or eyeball the precise tick rotations. Like right here, it's 1, 2, 3, 4, 5, 6, 7, 8. 1, 2, 3, 4, 5, 6, 7, 8. So I know I'm getting on average 8-tick rotations. That's good volatility. Yeah, you can kind of eyeball it on a more standard chart like that. But again, if you guys would like to get Auction Vista with Jigsaw, save $30, use my affiliate link below, and use the coupon code. So this is about sweet spot volatility for me. This is where I thrive at my best. And again, I recommend watching the last video here because in that video, I do talk more about my trading techniques a bit and how I want to make certain adjustments and use certain techniques depending on what kind of volatility there is. And there needs to be a different approach for very low volume, low volatility versus high. But there are two opposite ends of the spectrum where it can be too fucking low, too dead, or too high and too extreme. And you got to see an example of that. You got to see where it was rotating 4 to 3 tick rotations. I statistically perform like shit in that type of environment. Now, if there's some higher time frame shit setting up, I might go for it, but typically I need to see more volatility. Whereas where the book completely thins out, like right as FOMC is releasing, the volatility is way too high because the book has thinned out and the volume is coming in really high as well. So what I encourage you guys to do is, if you're trading the ES, what is the average rotation on a 3-second chart where you statistically perform the best? And what I would do if I were you is keep track of that, review those sessions, make tags for that. So you can make 3 tags and you can tag every trade. And was that trade performed in low volatility, medium volatility, or high volatility? And now that you've watched this video, you have an idea of what those 3 look like. So I would say this current environment right here, it's still pretty high volatility, but it's more on the medium high side. But see where you statistically perform better in. And it is my belief that most day traders perform better in higher volatility environments. And the years 2020 and 21 were higher volatility environments. Now we're in 2022 and the market is a lot choppier, and we do hit a lot more periods of lower volatility trading. And a lot of traders are having a hard time dealing with that. So it is my belief that you, again, especially if you plan on being a scalper, if you're an intraday hold trade type guy who is, holding and taking 1-2 trades a day and that's it, this may not be as important for you, but maybe it will be. Maybe it'll help you understand ways that help you execute better. But if you're trying to scalp or whatever, volatility is so important. It is so important. Again, there can be too much, too little. And the best way to identify that is, what is the average rotation on a 3-second chart? So that's how I keep track of volatility again. And that is the difference between volume and volatility. And that's how they kind of intermingle with each other. So I hope you guys enjoyed that video. I hope you guys are happy that I have a visor again, even though it's yellow. It's kind of cool. So anyways, I will see you in the next video, and please give me a thumbs up, like, subscribe to the channel, and we'll see you in the next one.